Hello, my name is Goncalo. I'm a co-founder and CEO of SyndicateRoom. And SyndicateRoom is a crowdfunding platform. And just like Emily, I'm going to clarify, every time I say crowdfunding, I mean equity crowdfunding. That's what we do. It's on the equity. So it's investment in exchange for shares. And I'm here to talk about why is crowdfunding growing? Why is it growing so fast? I mean, the growth has been, in the UK in particular, has been absolutely phenomenal. But there are certain key elements behind this growth, and that's what I'm going to be looking at. SyndicateRoom pioneered the investor-led model, which I'm also going to explain, because that's part of why this growth in crowdfunding as a whole. So first of all, it's really important that people understand crowdfunding, as in equity crowdfunding, is not a charity. Companies that don't have a profit-oriented pitch really struggle to attract money. It's for investment. People are expecting financial returns. They're not necessarily expecting the aggressive returns that, for example, venture capitalists might be expecting. But if they are investing, they will be expecting some financial returns. And the really interesting part is, although it's not a charity, we can see on our data as part of our platform the amount of interest that people have on projects, on companies that make this world a better place. So although it's not a charity, people are investing for financial returns, but even then, the companies that make the world a better place, or that have the ability to make the world a better place, fare much, much better than companies that they still get funded, they just don't attract as much interest. So I need to move. So two things that crowdfunding really needs and why it's growing so fast. Its first one, it has to be sustainable. It has to work for investors. If we are here and, at the moment we are in this auditorium, I can see it in 5 years' time. We're in an auditorium 10 times this size, right? But in order for us to be in an auditorium 10 times this size, it means that the whole industry has to work. It has to be sustainable for investors. Investors have to make money because that's how they recycle capital. That's how, in 5 years' time, they won't be investing the same amount of money again. Chances are they'll be investing 10 or 20 or 50 times more money because they're just dipping their toe into the water now. If we make it sustainable, if we make it work for investors, the future is very, very rosy for the industry indeed. And this is how the future of crowdfunding is going to be measured. At the moment, not just crowdfunding, but also sort of peer-to-peer lending and the whole sharing economy is very much based on growth, on numbers, on money going in, which is great. It works for now. We're just beginning. We're just barely scratching the surface. But really, the real measure in the next 5 years or 2 years is going to be not the money going in, is the money getting out for investors. Because that's really how you build a sustainable business, a sustainable industry. Equity. Remember, when I say crowdfunding, it's equity crowdfunding. And these are two definitions on equity that I think that are really interesting. The second one is the shares, right? It's investment, is in exchange for shares. The first one is about being fair and impartial. And that means that one of the reasons that certain parts of crowdfunding is growing so fast is because investors are having access to the same investment propositions as the professionals want to invest their money in, rather than on everything else. And that brings me to two different models of crowdfunding. One is the investor-led, which we pioneered at SyndicateRoom, and the other one is company-led. Now, these are two different models. It's not one is better than the other. They're just different approaches to it. And this is why and how we started SyndicateRoom just over 2 years ago. I live in Cambridge, and I was working out with business angels and venture capitalists, and I could see all these really exciting companies they were investing in. I could see all these inspiring entrepreneurs that they were investing their money in. And at the same time, I could see crowdfunding taking off, and I could see the interest of people investing online into companies. However, the problem here becomes that The top one is the investor-led model, whereby the professional investor meets the company, negotiates investment terms, the valuation, the investor protections, and so on. There's been a lot of conversation and discussion around valuations in crowdfunding. The second one is company-led. That's where the company dictates the investment terms. And the conversation, there's no conversation. It's just one way. Here are the terms. Do you want it or not? And of course, as an entrepreneur, I've done exactly the same. We raised finance from business angels. And when I presented our business plan, and they asked, OK, fine, we'll invest. What is the valuation? Being an optimistic entrepreneur, I said, well, I think our business is valued at this much. I said, actually, we think it's this much. And you basically get into that negotiation where you get to the middle, where both parties are equally pissed off with each other. And there you go. That's the valuation of an early stage business. There are no revenues, right? So that's how you do it. However, on a company-led, that negotiation doesn't really exist, doesn't happen, doesn't take place. And that's a really healthy negotiation, because that's how investors get the terms that they think that they're going to make money. So what we did at SyndicateRoom was basically to allow the crowd to invest together with a professional. So in SyndicateRoom, every single deal always has to have a professional investor, a business angel or venture capitalist or family office leading the funding round. And then we allow the crowd to invest in the exact same companies, in the same deal, with the same economic rights. So our whole vision, and that's the key part why we're growing so fast, is that it doesn't really matter if you're a retail investor, just an individual investing £1,000, or an institutional investor investing £10 million. When a pound per pound invested, everybody makes or loses the same amount of money. So you're sharing the risk and the reward fairly with the professionals. And that really has catapulted us and made us grow a huge amount. Because what we created was sort of the crowdfunding 2.0, which is disrupting the disruptors. The people that have already disrupted the early stage finance, we disrupted their model by creating this syndication model. And we basically broke with the status quo that already existed with crowdfunding. The results are phenomenal, because finally, very sophisticated online investors are coming to the industry and are gaining, it's gaining that credibility, it's getting that interest from people that can invest serious amounts of money online. But at the same time, without forgetting individual investors that maybe they can't put that much money. But that's the whole spirit of the thing, is that it doesn't really matter how much you can invest. You have access to the opportunities as the professionals are investing in. So you get the professional investors, very well-known business angels, VCs, and so on, leading the funding round. Then you get very sophisticated online investors. What this means, and this is so one part is the very sophisticated investors and results, but the other one, which is really, really interesting, is the sectors that get funded with this model are completely different from the sectors that most people associate with crowdfunding. Most people associate crowdfunding with consumer products, with this really cool brand, with a brewery, with a restaurant, with a Mexican restaurant, with a Mexican brewery, who knows. But here, look at these. These are completely different sectors. About a third has been in life sciences. Those are pretty complex sectors, right? Engineering, software, hardware. The really interesting part is that, and back to my initial slides, is that those companies that make the world a better place, or have the ability to make the world a better place, fare so much better than others. The others still get funded. We've invested in property and films, and really cool film, actually, with Simon West as the director. But the majority goes into IP-based sectors. And the reason for that is that you have a lead investor that has experience in that sector, validating the funding round by putting their name against it and say, yes, I am willing to invest £500,000 of my own money. And now, do you want to come in with £1,000 or 5,000 or whatever you can afford? But if you come in, we're sharing the risk and the reward fairly. If you make money, I make money. If I lose money, you're losing money. And the sectors that you get funded are representative of actually what the professionals like to invest in. So it's a much broader sector distribution. Now, 2 years, I've been talking about this for 2 years, 2.5 years, and I had no data to prove that our model worked better than other models. But now we're getting the data. And this is really interesting. So out of the deals that get listed on SyndicateRoom, 80% achieve their target. of the funding round. So 80% close their funding round, which is phenomenally high. That's more than twice the average in the industry. So it's better for entrepreneurs. What about investors? Well, this is actually out of date. I sent this presentation last week. We've closed a few. So we had about 77 companies. And out of 77 companies, only one completely failed and people lost all their money. And another one returned most of the money to their investors. So that's actually a failure rate of less than 3% versus about 25% in the industry, which is, by the way, not that bad at 25. But if you think that the companies that fail on our platform, that stop trading, are about a tenth of the average in the industry, which, by the way, includes us, so we bring that average down quite a lot. You can see the potential for this model, the future of this model, and on how it works. So what is the future of crowdfunding? I think it's definitely the investor-led model. That's how you capture the more sophisticated investors. That's how you capture the really good companies that you want to capture as an industry, because that's how these industries are made, are not by bad investments. They will be made by good investments. And these are two figures of the growth. The left one was by a study by these two universities, MIT and Toronto, and this analyzes the growth on angel lists of the non-syndicated versus the syndicated deals. And the syndicators are in blue and just go through the roof. This is our growth versus the company-led model here in the UK. And you can see the similarity on the exponential growth when compared to the company-led. So I definitely believe that this is the future of crowdfunding, is to allow online investors to invest where the professionals want to invest in, rather than where the professionals don't want to invest in. Some numbers and some figures to prove our point is that, look at the average investment, for example. £16,000 average investment online versus about just over £2,000 on the company-led model. This shows that even though the minimum, you can invest a lot less than 16,000, but the average is 16,000. And that is because we are able to attract far more sophisticated investors, which, as far as I can see, that's absolutely fine. If they're investing as part of the crowd, that means that the crowd is better off. The average funding round is a lot bigger as well as a result, and the failure rate I've already talked about. So what's the next step? What's next? We've become the best in the world at doing crowdfunding on the early stage, and we've disrupted that space, and we're growing incredibly fast. We're doing really well there. So what's next? And we thought that if we disrupted the disruptors, we might as well disrupt the incumbents. So our move that we did, and we announced it about 3 weeks ago, was we were the first, well, actually we are the only crowdfunding platform in the world that got FCA authorization to list IPOs on the main market on the London Stock Exchange. And we started with a big one, with a £200 million IPO, where the crowd invested alongside institutional investors to a healthcare IPO on the premium segment of the main market that the crowd would never have access to that IPO. Same thing with a placing. We did a placing last week where the crowd would never even know that that existed at the discount. Me. And so we became a member of the London Stock Exchange, which means we can list. This doesn't mean we got listed, by the way. Some journalists thought this meant that we got listed and published rather embarrassing articles that we got listed. I got really interesting and excited calls from our shareholders saying, great, congratulations, where's my check? And I had to explain them, not quite there yet, but we can list other companies, which is really exciting, and that's exactly what the change is getting. That's the sort of disruption. It's an absolute game changer. I was just talking earlier, I was told that Nomura just decided to close their capital markets part and let 2,000 bankers go. Well, we're moving into that space, and we're basically using one platform to go from idea to IPO. So we're allowing companies to raise finance from the very, very beginning, from idea all the way, same platform, SyndicateRoom, all the way to IPO. And if you think from a company perspective, the type of investor, the type of people that you have to contact, and the process to raise for early stage, seed stage, is very different from early stage, and then before pre-IPO, and then at IPO suddenly you start talking with bankers and so on. It's a completely different process, different people. Well, actually, forget all of that. That's the big disruption. One platform, right? It's the sharing economy again. It's getting one platform for the company to use the same platform, SyndicateRoom, all throughout the entire equity journey. And that makes the process much more efficient to companies, much easier, and much cheaper. And that is an absolute game changer in a market that hasn't changed in decades, which is the capital markets, where everything is still done by phone to their mates and letting their mates invest. So thank you very much, and I hope you enjoyed the presentation. Thank you.
Great. Goncalo, thank you so much for coming. You're going to be around for the panel, right?
I am, yes.
Okay, great. So we're going to, because we're running out of time, thank you, and we'll see the panel. Nikki, what do we have now?
Right, so we have a very special guest joining us now, Father Mark Haydu, who's going to be speaking to us about what the Vatican is doing to engage the online global community.
Wow, that's amazing. Vatican.